2 weeks ago, we made a video about undervalued stocks. And here is what that thumbnail looks like for that video. Had some positive feedback, so we made another one, round two, where we got more views because I guess this chill guy meme is really popular these days. And something interesting that happened as a result is I got into some conversations with some people about whether or not you should buy or sell. And I was saying, well, just because a stock is undervalued doesn't mean you should buy it. Similarly, just because a stock could be overvalued doesn't mean you should sell it. So this opens up this whole conversation about, well, then what's the point of even looking for these things? I gotta bring this back to something way more fundamental and way more basic. And first, let me make an analogy because it's holiday season. I've got my winter sweater on. Think about something like a 7 layer dip. Okay, you have your cheese, the salsa, some avocado, the beans, the whatever, all your 7 layers, and you have to have a nice chip that pairs with it. So let's say you get 6 layers perfectly right, absolutely delicious. And then when you go for the avocado, it's completely spoiled rotten. It's like brown, and you put it on anyways. You get to the party, and people are like, "This thing is gross. I don't want to eat this." Even though you might have 6 perfectly good layers and the best chips you've ever seen in your whole life, the avocado has spoiled the whole thing. Think about your investment portfolio or your stock picks as just one layer in the 7 layer dip. You want to get it right, of course, but it's just one piece of the puzzle. So when we're talking about stock picking and we're talking about wealth management, it goes into more fundamental layers, such as your risk profile. So how much risk are you willing to take? Are you willing to roll the dice? And what does that mean? We're going to look at it in this video, how to actually numerically measure and quantify the risk that you're taking so that you have a deeper understanding of choosing stocks and building your portfolio and living your life and making lifestyle choices in line with your risk profile. And importantly, in addition to your risk profile, what are your values? It's really easy to get caught in this conversation about buying and selling stocks or taking risk or getting into Bitcoin or getting into gold or should I be in the bonds to take risk off? Well, maybe you should, maybe you shouldn't. It all depends. What do you want out of life? What do you want for your family? What do you want for living a healthy lifestyle? What do you want for getting out of the matrix or your cybersecurity threats? Or how about your spirituality or being able to sip a Mai Tai on a beach somewhere? That's what it all should come back down to. Your risk profile and your values is a good foundational layer on top of which you can build a resilient, durable financial plan that is comprehensive and durable. Throughout my career, I have used a lot of different risk assessment tools. I'm yet to find one that is perfect. There's no tool that you can just send out to somebody and say, do this and get back to me. Let me know what your number is. It's much more of an interview process. I'm going to walk you through one right now. And by the way, about risk, I've got a shiner right here and another one here over the eye from martial arts sparring the other day. So I mentioned that because risk is not just about buying and selling stocks or a business endeavor that you're thinking about or if you should buy a new house. It's about doing activities that we understand may come with some physical or emotional duress, but we can justify them because they provide us a lot of value and joy and pleasure in our lives. For me, it's about health and wealth, and I'm willing to do some things that maybe I tell my doctor and he says, you shouldn't do that, but you know what I think is I should have better defense so that I don't get hit. Okay, so I'm going to walk you through this, and like I said, it's really an interview tool. I would never send this to someone and say, let me know what your score is. I would be there like an interview to figure out about them, asking questions and asking follow-up questions and observing them, how they think about these concepts. If it's me, I'm a little bit more sophisticated in the market, so I have different takeaways. But anyways, you start here. In general, how would your best friend describe you as a risk taker? A real gambler, willing to take risks after completing adequate research, cautious. Probably this one makes some sense. Okay, I like this question because you're on a TV game show. You can choose one of the following. Which would you take? Here's where you can see if they're thinking mathematically or not. $1,000 in cash, 50% chance of winning $5,000. So you can run math here. 0.5 times 5,000 is actually worth $2,500. That's just the mathematical equation. So if you had this 50% chance 10 times, and you took it 10 times, it would be 10 times 2,500 would be your outcome, theoretically, according to math. Same with a 25% chance at winning 10,000. So that's 0.25 times 10,000, so you're making $2,500 each time you take that chance, mathematically. 5% chance at winning 100,000, now it's 0.05 times 100,000, worth 5,000. So you win 1,000 in cash, you win 2,500 in cash, you win 2,500 in cash, you win 5,000 in cash. But this is this idea that you only have one opportunity here. You don't get to play this out multiple times. I bring that up because there's this idea about optimal playing style in poker. So let's say that this guy's got an ace and a king here, and he's going up against someone who's got pocket twos. Okay, and then there's a third player, but we don't know what this third player has. So now you can see 39% chance, 31% chance, 27% chance, and you can start to play this out. Okay, so what would happen if it's a 7, 8, 9 of diamonds on the flop? Okay, now the odds are changing. We had this king of diamonds, we got a flush draw, but there's a straight draw out there. Okay, so if it's poker, you have what's called an optimal situation. You could memorize this to the point that you're making optimal decisions in every hand of poker that you play. So in this situation, I raise 20% of the time. I never call here. I'm either raising or I fold. And my raise should be either double the size of the pot or triple or quadruple or 5 times. And I might go all in or I might fold. And if you play this hand a million times, if you're playing it the optimal way, then you're going to make money. Okay? So you can do this in a mathematical projection to figure out the optimal way to take risk. But people aren't like this with their investments, and this is a one-time opportunity. So you have to choose. Most people are probably just going to say, give me the cash. This is, like I said, an interesting thought experiment. You just want to be able to reason people through the different choices and see what they ultimately say. Because if they really do think, hey, give me this 5% chance at 100,000, mathematically speaking, it's the right answer. But it's also going to mean that they're going to show up as being willing to take bigger risks, which might not necessarily be true from an investment perspective. So, okay, I could go on and on, I could go back and forth about this. The point is, when you do these risk assessment tools, you should be interviewing the person that you're doing it with, that you can get a sense. Now, we'll just do a few more of these. Once in a lifetime vacation, 3 weeks before you plan to leave, you lose your job. What would you do? Well, now I can't afford it, so maybe I'm going to cancel the vacation. Okay, this is a risk averse decision. Or they might think, well, it's already scheduled, it's already planned. I have 6 months of an emergency fund. I'm going to go as scheduled. I'm going to prepare for my job search. And again, maybe there's an optimal way of doing this from a risk adjusted perspective, but this is more just conversational. This is about understanding the personality dynamics of who you're working with that you can then use to build a more robust conversation about risk to ultimately be able to then bring it back to this risk assessment tool when you're talking about buying or selling stocks or assets or taking a new job or buying the new house versus renting it, and you have more of a foundation. So let's just scroll ahead. Here's one. What do you think about the word risk? Does it mean loss to you? Does it mean opportunity? Does it mean uncertainty? Does it mean thrill? Again, a great conversation starter. Let's see, another one where you have to do mathematical modeling, where there's best case and worst case scenarios, defined outcomes. Then again, the sure chance versus 50% chance, more mathematical modeling. If you got $100,000, what are you going to do with it? Give me the stocks, baby. And okay, so it goes on and on here. Let's just get to the end here where eventually you can put in gender, your age, other items about how much money you're making, what percent you would allocate for yourself if it were up to you. And eventually you get to a score. My point that I've made a couple of times would be that the score is not definitive. It's a helpful tool, but you want to have this conversation to where you have a really good understanding of each other and you're putting your cards on the table too. You're explaining your thought process about how you would be picking and choosing different things. And it's a great way to build rapport, establish the relationship, and now you have a decent jumping off point for the future as it pertains to this risk score, this risk profile. Okay, so this is the exciting stuff when we're talking about risk, and we've got the the four of a kind aces, and we're thinking about being in the casino, and we've got the chips on the table, and we're going all in, baby. But next, we're going to look at values, which it's much easier to anchor conversations about risk management and wealth management and about the generational values and lifestyle goals we can achieve together if we anchor it to values. You got to be careful. You can't just think about life as you're playing this game, you want to make more money, you got to get the maximum score. It's a dark path if you get too far deeply inclined thinking about it that way. There is such a thing as balance, and there is such a thing as we were talking about optimal risk score. We can say there's an optimal way, probably, to live your life. At least, you get to be anchoring that ship, or you can be the captain of that ship, I should say. So let's look at a values exercise to complement our risk assessment. Before we look at this values assessment, I have to just quickly look at TLT, which is the ETF for the government long bond, because it's often thought of that to avoid risk, you would have bonds in your portfolio. I just have to say, first of all, we nailed this. You can see we caught this MACD crossover to the downside. We lost a key support level, then we lost it again. That was a great short when everyone thought rates are coming down with the Fed cutting, but not quite. Okay, so I just wanted to, I had to pat myself on the back there and also say it's not necessarily risk off to be in the bond market because look at this. Okay, so let's say you're thinking about this pandemic. It's March of 2020, and here you are, March of 2020, and you say, okay, the world is too risky. I need to be in bonds because I don't want to take any more risk. Let me tell you something about risk, brother. From that top to this bottom here is about down 54%. Now I think we're closer. We're at this like $93 range. So what would that put us at? 93 would get us to about 50% down. But I just have to say, risk is not so easily defined as saying, I don't want to be in stocks anymore, I want to be in bonds, because there's risk there also. Okay, had to just get that off my chest. Now, a values exercise. So how does this look like? You get to here. Let me do this part first. So it's about living in alignment is about matching your real behaviors with your ideal values. Living out of alignment is a source of stress, dissatisfaction, and poor decision making. Now you get to here. I won't do this whole thing, but you'll get the idea. First, you have to discard. You have a discard pile and you have a keep pile. You can keep all of these. Diversity appreciates and respects individual differences. Yeah, sure. Creativity, importance on imagination, inspiration, and yeah, sure. Happiness, yeah, of course I want to feel happy. So on and so forth. You're going to go through all 51 of these. Excellence, autonomy, like a full self-driving car at a Tesla. Yes, indeed. Competence, yes, competence matters a great deal to me. Privacy, of course, do not tread on me. Work, yes, work is very important. Okay, so I'm going to be keeping a lot of these at the beginning. 1 second, I'm going to go through this and I'll join you again in step 2. Now, just like we did with the risk assessment, it's not something you give to someone and say, get back to me. You should be there for this process to walk them through it and be a sounding board to bounce ideas back and forth. You want to be able to reason them through this and just, sort of like a therapist would do. You're just there. You're just asking questions. You're picking and probing. You're taking some notes down. And now you get to this part. Well, now they have to choose 15. So now maybe they have to really hone in. Okay, so family means a lot to me. Maybe they're in this situation where they're choosing between wealth and helping others. So let's say they want to have money, but if they had to choose one, they want to be able to help others. Okay, so now you're thinking from a wealth management perspective. Okay, let's set aside some money for maybe not hyper growth investing, but now let's get into the donor advised funds or the legacy considerations or the philanthropic considerations, right? Okay, they say security, for example. Okay, so what are you doing to have a plan B? What about your cybersecurity? Are you, how do you store your passwords? All these other conversations. Hey, this is a top 15 value of yours. Let's not talk so much about the stocks, but let's figure out what are you actually doing to protect your identity or to protect your family's freedom and security. So that's something. Um, and okay, so you get to your top 15, and I'm going to keep skipping ahead here because I think you sort of get the idea. Gets even more challenging between step 2 and step 3. We narrowed it down from 15. Now we got to narrow it down to 10. So you're going to get to a point where as you're walking somebody through this, you have to actually pick which ones are you going to leave out. So for example, for myself, I don't know if this is what I would pick if I was doing this, but let's just see what happens here. And we get to okay, now it's challenging. Now I'm thinking, well, my integrity matters a lot, but is that the same thing as ethics? But would I sacrifice my integrity and ethics to not count my spirituality? And what you're doing, you're taking notes as a wealth manager perspective, is now you have all of this information downloaded about this person that you have this foundational layer. They want to know, should I buy Nike? Should I buy InPhase? Should I buy Boeing? You said these stocks are undervalued. It's like, hold on a minute. We just did this values exercise where we determined that the five most important things for you are family, security, and whatever they are, and your risk profile. We talked about this too. You really want to gamble your future based on an undervalued stock when the portfolio is doing just fine. Like, hey, there is such a thing as doing too much here when we know that your risk profile is this and your values are such and such. That's your job as a wealth manager, not necessarily to outperform, although, we can have that conversation about performance, but you're really there to sort of be like a governance mechanism for this household to keep them in line, to walk them off the ledge, really, to never even let them get to the ledge, and make sure that everything is on track and that they're living a happy, healthy, meaningful life now and into the future for this generation and beyond. That's the job. So if you're getting stuck in these conversations about, hey, you said the stock is undervalued, should I buy it? It's like, hey man, we got bigger fish to fry. So I'm not going to keep doing this. I think that you get the point here. Um, so let's move on to the final point here. Once we have a risk profile and a values assessment completed for a new household that we're going to be engaged with and working with, there's much more to do from that point forward. But the important thing is now we have a relationship established. We've built some rapport. We've clearly identified the way that we work and how we define our goals. And we've been open. So the conversation is moving outside of the spreadsheets and away from the numbers and more of a soft skill type of emotional, intelligent type of conversation. What we're going to do next is this download. Now we are going to get the information, the bank statements, the tax returns, the business interests, what the portfolios look like, um, names and ages of all the people that are involved, target dates, like if there's a university fund that we're planning for, or if we're going to be putting a down payment down within 5 years. So then we have specific targets and goals and dates and times, and we can start building. But this is our foundational layer. Okay, so this balance that we're going to strike between a risk profile to, be out there, being the man or the woman in the arena, taking on the slings and arrows of the outrageous fortunes of this world, um, and balancing that between the values exercise to make sure that we are anchoring ourselves to something real and meaningful, and something of real substance, not just like turning $100,000 into $100 million, but making money and then using it for the right reasons to give ourselves fulfillment. And yeah, there's your foundation. And I hope that helps to explain how you can look at some dogs of the stock market and how you can just be a chill guy identifying dogs that are starting to put up good returns, but you don't care because you're just a chill guy who manages wealth. But it's about health and wealth and lifestyle success and fulfillment, baby. Because you're just a chill guy. You don't care if you pick a stock and it goes up 100% or 200% because you know if you pick a stock, you're still on track to achieve all of your goals regardless of what happens. And that's real financial planning, and that is real comprehensive wealth management.